Have you ever wondered how businesses keep track of their finances? This question brings us to the heart of our topic today: accounting. Accounting, in its most basic form, is the universal language of business. It's the systematic process through which businesses record, summarize, and analyze all the financial transactions they undertake. Let's break that down. Imagine you're running a business. You have money coming in from sales and money going out for expenses like salaries, rent, and supplies. All these ins and outs can become quite confusing. That's where accounting comes in. It records every financial transaction, no matter how small, providing a detailed financial history of the business. But accounting goes beyond just recording. It also involves summarizing this information into financial statements. Think of these statements as a business's report card. They give you the big picture of how the business is doing financially, showing you where the money came from, where it went, and where it is now. Yet, the beauty of accounting doesn't stop there. Accounting also involves analyzing these financial statements to understand the financial health of the business. It's like a doctor diagnosing a patient based on their medical reports. By doing this, accounting helps businesses make informed decisions about their future. So why is accounting important? Because it provides transparency. It allows everyone involved, from the business owners to the investors, to understand the financial position of the business. It ensures that businesses are accountable for their financial decisions. And most importantly, it helps businesses plan for the future. To put it succinctly, accounting is the backbone of business. Without it, businesses would be like a ship lost at sea, with no compass to guide their financial decisions. It's the tool that businesses use to keep their finances in order, to plan for the future, and to ensure they are accountable and transparent to all stakeholders. Now that we've introduced accounting, let's delve deeper into its nature and need. So, what is the nature of accounting and why do we need it? At its core, accounting isn't just about crunching numbers or filling out spreadsheets. It's about understanding the financial health of a business. It's a way of keeping score, of tracking successes and failures, profits and losses. It's a way of telling a story of a business's journey. Imagine a journey without a map or a game without a scoreboard. Confusing, right? That's precisely what running a business without accounting would look like. It's like driving blindfolded, not knowing where you're going, how fast you're moving, or what obstacles lie ahead. Accounting provides the roadmap for businesses, the scoreboard for the game of commerce. It offers a clear, quantifiable picture of a business's financial health, the assets it owns, the liabilities it owes, and the equity it holds. It paints a picture of the revenue coming in, the expenses going out, and the profit or loss that results. But beyond simply providing a snapshot of a business's financial state, accounting also drives decision-making. It helps businesses decide where to invest, where to cut costs, how to price their products, and even when to shut down or expand. It's the backbone of financial management, helping businesses plan for the future, manage their cash flow, and ensure they have enough funds to meet their short-term and long-term obligations. But that's not all. Accounting also plays a crucial role in holding businesses accountable, ensuring they adhere to financial regulations and pay their fair share of taxes. It helps investors make informed decisions, lenders assess creditworthiness, and governments monitor economic health. In essence, accounting is like the language of business, a universal tongue that speaks in terms of assets, liabilities, revenues, and expenses. And just like you need to understand a language to appreciate a beautiful poem or a stirring speech, understanding the nature and need of accounting helps us appreciate its critical role in business. But how is it classified? Did you know accounting isn't just one big blob, but is actually classified into different types? That's right, the world of accounting is diversified and tailored to fit different financial needs. Let's break it down. First, we have financial accounting. This is the type of accounting you're likely most familiar with. It's all about recording and classifying business transactions and preparing financial statements that can be used by external parties like investors or creditors. Next up is management accounting. This branch is more internally focused. It provides information to managers within an organization, assisting them in planning, controlling, and decision-making. Lastly, there's cost accounting. Now this one is interesting. Cost accounting is all about analyzing the costs of products and services. It aids in budgeting, cost control, performance evaluation, and strategic decision-making. Different types of accounting serve different purposes, but how do we evaluate accounting information? The value of accounting lies in the quality of information it provides. But how do we evaluate it? Let's delve into the criteria for evaluating accounting information, which are relevance, reliability, comparability, and understandability. Firstly, relevance. This is about the capacity of accounting information to influence economic decisions. It's all about timing and significance. Information that arrives in time and can make a difference in decision-making is considered relevant. Secondly, reliability. It refers to the accuracy, veracity, and objectivity of accounting information. Reliable information is free from errors and bias and faithfully represents what it purports to represent. Thirdly, comparability. This aspect allows users to identify and contrast the similarities and differences between two sets of financial data. Accounting information should be consistent over time and comparable across companies, enabling users to make meaningful comparisons. Finally, understandability. It's crucial that accounting information is clear and easy to understand for its intended users. This doesn't mean that all information needs to be understandable by everyone, but it should be comprehensible to those with a reasonable knowledge of business and economic activities. Just remember, the ultimate goal of accounting is to provide useful information for decision-making. Each of these elements, relevance, reliability, comparability, and understandability, contribute to the overall quality of the information provided. Evaluating accounting information ensures it serves its purpose. But who are the users of this information? Accounting isn't just for accountants. There are many users of accounting information. But who are they? Let's dive right in. First up, we have business owners. They use accounting information to make strategic decisions, track performance, and plan for the future. They're interested in profit figures, cash flows, and return on investment. Basically, anything that helps them understand how their business is doing. Next, we have investors. They're the ones who put their money into businesses, hoping for a return. To make informed decisions, they rely on accounting information such as financial statements and ratios. They need to know if the business is profitable, stable, and worth their investment. Then we have creditors. These are the banks, financial institutions, and anyone else who lends money to the business. They use accounting information to assess the ability of the business to repay its debts. They're looking at liquidity ratios, debt ratios, and overall financial health. Employees too are users of accounting information. They might use it to negotiate salaries, bonuses, and understand the financial security of their employer. Lastly, we have government agencies. They use accounting information for taxation purposes, regulating business activities, and making economic policies. They're interested in the company's income, expenses, and assets. Understanding the users of accounting information helps us appreciate the wide reach of accounting. But what's the theory behind all this? Behind every practice there's a theory. So what's the theory behind accounting? It's a good question and one that leads us to the heart of how accounting functions. At the core of accounting theory is the simple yet essential equation: assets equals liabilities plus owner's equity. This equation is the backbone of the balance sheet, one of the key financial statements in accounting. It signifies that what a company owns, its assets, is financed either by borrowing, liabilities, or by the owner's equity. But how does this equation actually work in practice? This is where the double entry system comes into play. Originating from the Italian Renaissance, this system is the very DNA of accounting. It ensures that for every financial transaction, there are always two entries made, a debit and a credit. If a company purchases machinery, for example, it increases its asset account by debiting it, and simultaneously, it increases its liabilities or owner's equity by crediting it. This dual action ensures that the accounting equation always remains in balance. Now, you might be wondering why we need such a system. The answer lies in its inherent checks and balances. The double entry system provides a clear trail of each transaction, making it easier to trace any discrepancies or errors. It also ensures financial transparency, a critical factor in today's business environment. This system is not just an arbitrary set of rules, but a logical structure that mirrors the economic activities of a business. Every transaction that a business undertakes, be it buying, selling, investing, or financing, is reflected in this system, making it a true representation of the business's financial reality. But remember, these are just the basics. The world of accounting theory is vast and intricate, encompassing principles, concepts, conventions, and standards that guide how financial information is recorded, presented, and used. Understanding the theory behind accounting helps us appreciate the logic and structure of this field. And like a well-crafted puzzle, every piece has its place, working together to create a complete and accurate picture of a business's financial health. So there you have it, a brief introduction to accounting. We've explored its multifaceted nature, from the essential definition to the critical need for its application. We've delved into its classification and evaluation, highlighting the importance of understanding different accounting systems and their assessments. We've identified the various uses of accounting information and dived into the intriguing world of accounting theory. Remember, accounting isn't just about numbers, it's about understanding the financial health and performance of a business.